Okay, I'd like to welcome everybody tonight. And last week we talked about personal digital libraries and emergency communications. And I think we had a real good discussion. Wish we'd had more people on it. I kind of agreed to say a little bit about those two topics every week. Um, And the personal digital library is just a way of keeping a large volume of data, at your fingertips, just in case, you couldn't have 2 tons of printed material with you. And if maybe the internet was down and you couldn't ask Siri or whatever, and you needed information to get to your daily life. So that's kind of what that's all about. And then um, emergency communications. Mike, would you like to give a quick summation of what a mesh network is? And
Yeah, so it's nodes traditionally like your TV or your cell phone communicates with one antenna. There's typically one endpoint. With a mesh, you have the endpoints, in this case radios, that communicate with each other and pass messages on for other nodes in the network. So instead of having to go back to one central antenna and then back out like a star diagram, you can think of lines connecting everybody in the mesh, and you might not have a direct connection with the person you want to talk to, but it'll through a mesh, the communications will get passed to that person eventually, or to the desired target eventually.
and it could go through several nodes in the meantime, and they wouldn't see the communication. They would just pass it on. So
Right, and this for the mesh testing, that's correct. It's not, you can encrypt it, and as long as you can talk to one node, and each node that you can talk to has connection to somebody else upstream, the distance between yourself and who you want to talk to doesn't matter. It's arbitrary. As long as you can find a way to connect the dots, so to speak.
and we kind of went to that topic just because of the poor people in North Carolina area. One of their biggest problems that I think caused the most worry and fear and dread in their lives was the fact that they couldn't reach out to anybody on cell networks or landlines or anything else, and they had no idea whether anybody was going to help them or not, or how to request that help. And they were just kind of sitting there in the dark, so to speak. And one of these mesh network radios would have prevented that, hopefully. So, anyway.
How close do the nodes have to be able to be? I know that Mike's area would be much more difficult. It would be
Yeah.
constrained by the geography of the area. But if you had a clear line of sight, what are they thinking that the distance would be? If you were in the Texas Panhandle, which is very flat, and you can see for miles and miles, is it a 5 mile, a 10 mile, 50 mile?
Well, I think it varies, but I think they say 20 kilometers is easily doable. So
Okay. I was just wondering what the configuration and density would need to be able to pass on.
yeah,
Interesting.
yeah,
Yeah.
and um, so there's since we're recording this, I'm afraid to sound too authoritative because I'll be wrong, and we'll learn more later. But my my research so far indicates that there's two frequencies in the US that you can operate at, one of which requires the lower one and longer range. You cannot transmit on encrypted, and you have to have ham radio license. At the higher frequency, you do not. So for us normal people, that would be what we would use. And that's like 915 megahertz, I think. But even that will bounce off of hills and things like that to some extent. So you don't necessarily have to have, certainly the topography can make it challenging, but for instance, T-Mobile at my house in the 900 megahertz range can make it up the hollow, but there is no direct line of sight. So
it's kind of like the old Bewitched TV series when Dr. Bombay. It was the atmospheric continuum.
Yeah.
It's bounced in.
So it does have pretty good, darn good range.
Yeah. Well, anyway, remind me at the end if we have time. We'll also do our session, our 5 minutes on water, and
a question along those lines. Do you need a special piece of equipment in order to be in such a network?
Yes, but it's not very high cost. I don't know, Winston, if you've gotten more educated since we've talked. Mine hasn't progressed all that far, but
seems like $25 to $35, and
what is it called again?
Mesh-tastic.
Mesh-tastic. So if I went on
that's the app that runs on your phone.
Oh, it's an app. Oh,
and then you have to buy a physical radio that hooks up by Bluetooth to your phone. And so you basically, in that app, you just send a text, just kind of like you would normally, but it goes out through that radio instead of going out, on the cellular network.
Now, to be clear, you can buy some that don't require a cell phone.
Okay.
But you spend more because then you have a screen and a keyboard, right? So.
Can I ask a question?
Sure.
Am I doubling? Let me get my phone the other way. Winston, have you talked? Now I need to turn my Bluetooth off. I'm sorry. Have you talked to Jerry North about any of this kind of communication stuff? He's quite the expert.
I did a while back, and I tried to get him on one of these, but I haven't accomplished that yet.
Okay, because I know he's got a lot of information about this kind of thing.
Also, Mark Nielsen is pretty competent in this stuff too. Although maybe not this particular product. This particular product is fairly new, and it seems so far to be superior to the previous things. Probably the two things that are inexpensive and could be replicated over the geography of our ward is probably this, and then the Chinese Baofeng radios. And with those radios you get voice, but it's about the same distance and coverage and stuff. And and you have to either directly connect to someone and have them relay it, manually, or so I think this one's superior in that, you could hit your whole network or hit any person in your network, without other people being involved necessarily, as long as they had their radio turned on. So, But yeah, there's other options that just like if everybody had an iPhone that was model 13 or 14 or greater, um, then you can do text over satellite if the cellular network's down. But you know, get that's a pretty expensive piece of equipment that everybody may not want an iPhone. But anyway, but everybody's pretty much got a smartphone that one of these radios could hook up to. So that's kind of and we need to get some stake involvement too, because I think you know that probably should go up to that level before we decided to standardize on something. Although we could do some testing, and we could do live testing every Tuesday night, for example. If we had a few with that wanted to purchase one of these radios. Anyway. So anyway, let's go forward on our normal stuff right now, and then we'll get down to the topic tonight, and we can pick on this a little bit more at the end if anybody wants to. So today markets were mixed today, but gold and Bitcoin both hit nominal all-time highs today, if that interests anyone. Thought it was interesting that gold and Bitcoin were kind of running together for a change. And the stock market really wasn't running with them. So that gets kind of back to our topic of the day. Have you started your diversification? If not now, then when? And the last few weeks may have been a gift to us that still giving us some opportunities to raise some cash or diversify into things that might stand up to maybe a stagflation environment, for example. But gold was at 27.75 today at the close, and goldbacks, of course, were up a little bit today, about a dime since last week. So they're at 548. Silver was up at almost $35. And the gold silver ratio was back up over 80. It was 81. So still, I just said that gold had made a nominal all-time high, but look at silver, in January of 1980, in real dollars at that time, it was $50 an ounce. So, a lot of these things depends on when you buy them. There's not many buy and holds nowadays. Everybody wants something they can buy and forget. Well, there's not too many of those items left. Although if you look at silver, in the 60s, you could still get silver dimes and quarters in your pocket change, and after you if you paid a dime for that dime, and now that dime's worth $3.50, so it's gone up 35 times, since then. So that seems pretty good return on your money over a long period of time. But like I said, if you bought that same silver dime for $5 in 1980, you're still underwater for 44 years later. So sometimes it's a good investment, and sometimes it's not. If you just waited 2 or 3 years after 1980, it was down I think silver dropped down from $50 to below $5. You'd be in pretty good shape again, but be aware of that. Everything has its season. So tilt and zeros were both mildly up today and look like they're trying to put in a bottom. Traditionally, that would be, probably one of the safety valves for going into a recession or stagflation time period is long-term bonds. But there again, um, it's not a buy and hold thing, because if interest rates go back up, and you lose principal on your bonds. So tilt looks pretty good right now, though. So wheat was up a couple of, I think, 6 cents today, 5.13. So there's another thing that, and I'm gonna relate all these hopefully to the common denominators of where you're coming from. Like wheat, if you've got if you've only got $5 at the end of your week to spend, then you probably ought to buy a bag of wheat or a bag of beans or bag of rice, probably more readily available, and stock that away, or 5 cans of food, whatever, uh, you know, as opposed to somebody that's got $10,000 to put towards next year's food supply, or $100,000 in a IRA or something. You go a little different approach. Like if you got $7 a week available, you could buy two silver dimes at a pawn shop.
Yeah.
Do that every week, and you would have something eventually. But it's all relative. So PDBA, which is agricultural commodities, that was up a little bit today at 36.57, and PDBC, which is a more diverse commodity and has a lot of energy components in it, which is probably why this was down a few cents today. Because let's go ahead and talk about oil right now. Oil was down to 69.66 a barrel today. So that's been a considerable, it was like $84 a barrel maybe a month ago. So it's come down considerably. So that would be why this particular ETF is down, probably. So oil and natural gas were down. So now we'll go back up, and which kind of relates to this same thing. Hopefully, all the industrial military complex stocks were down except for Boeing again, which was the same thing it was last Tuesday. So that means world peace is breaking out, right? And oil's coming down, so that says no war. So I hope they're right. That's what that usually indicates, or a major recession, or both. So anyway, they're trying to tell us something. Bitcoin was up today, and like I said, that was it double topped, and over 73,000. So don't know where it's going to go next, but pretty steep resistance there. And then Ethereum was up a little bit today. It's just strictly Bitcoin dominance. I mean, none of the other cryptos are performing near as well as Bitcoin. And it's been that way for at least a couple of months. So that's where it's happening in Bitcoin, not necessarily anything else. But Bitcoin may be the way it's acting now. It may really be the digital gold. We'll see. So we got
Brother Apple.
Yes.
On the topic of world peace or recession, I think I was listening to the All In podcast, and they were talking about the markets kind of pricing in a Trump win. And if you think that's true, and you sort of listen to what he proposed to do on the Joe Rogan podcast, where he was discussing kind of massive tax cuts and deregulation, but also massive cuts in government spending. It could be that they're sort of taking him at his word that he intends to both keep the peace and also suck a lot of government demand out of the economy and potentially prick the balloon, pop the bubble early. So that might explain why those things are down that way.
Yeah, it certainly could. Historically, our government solution to a recession or depression has been to, fire up a war, to get us out of it. And if he has no intention of doing that, changing their plans, so to speak, then yeah, that could definitely be part of it. So we talked about last weekend, this week, we had our record deficit at over 35 trillion, and we're paying interest over 1 trillion every year, just interest. So the government can't stand for interest rates to go too high, in my opinion, but somebody's got to buy those bonds, and they may not buy them with at 5% coupon rate. They may want 7 or 8 or 10 for the risk. And of course, we had Boeing with big layoffs, and Bank of America. UPS is looking at laying off a lot of people. Just remembering seeing the UPS truck come by today. So
it was a Penske truck today.
Oh, there was also a brown truck.
Yeah, and there was both.
Oh.
And the Penske truck almost ran me off the road on the way home.
So anyway, kind of, UPS laying off people is not a good sign of the economy, but so just like a water plan, I think everybody ought to have an unemployment plan. So anyway, we'll talk about that. And of course, we still got cleanup from Hurricane Helene and Milton. Maybe years in the making. War in the Middle East is still a toss-up, but hopefully the market's right in telling us that there's not going to be one. I'll go for that. So, seasonal information. Fall's still the best time to plant trees. Still got time. Still a few things you could probably put in the garden. Certainly garlic. And if you got bees, you probably need to feed them this year. And, good time to order your seeds for next year. I keep saying it's a good time to get a hunting license, even if you don't hunt. Might be a skill that you might need to pick up on. And same gun that kills the deer could defend your home. I recommend everybody have their potassium iodine supply just in case this crazy world we live in. And, maybe kelp would take care of that need also if you can't get potassium iodine. But like we said, Yoder's has it here in Madison. Of course, you can get it online. IOSAT is the official approved brand.
What's the name of that again? The brand?
IOSAT, IOSAT. It's got a 14-day supply of tablets on each packet or tab. Kind of the standard dose. If Lake Anna was to blow up or something. get sabotaged. If something worse came out of the sky. So anyway, now's the time to talk about any progress anybody would like to share. I mean, I've just been sitting around here on my duff. Haven't been doing nothing for the last week. So, anybody done any wood cutting or gardening preps or bought any supplies or don't mind sharing?
Picked up more pumpkins.
Yeah.
Pumpkins running out of our ears.
Not for long.
Winston, I have a question. What is the name of the product? I forgot to write it down a couple weeks ago. That you can get at the local stone quarry that you amend in your garden.
It's rock dust. So out on Route 3 there, ask for the finest stuff they got. They call it MS10, I believe. But,
MS10.
yeah, I'm not sure what that stands for, but
Okay.
that's their finest stuff. Just tell them you want the finest stuff they got.
And do they sell it by the yard or?
Yeah, or they'll sell you a pickup load for $35.
Okay.
Which a pickup load is not a yard. You don't want a whole yard.
Yeah, it's pretty heavy stuff.
Okay. So pickup. Well, okay.
Or you can just call them and tell them to bring you a dump truck load, and they'll do that too. But but
It takes years to get through.
It's what is it, high in calcium or?
Yeah, it is high in calcium and a whole lot of, since this was a shallow sea, it's got a lot of calcium from all the animals that died on it and fossilized, so to speak. And it's got, all the sea minerals, it's about as good as anything as far as there's it's got 70 or 80 minerals in it.
Well, so it's basically like pulverized limestone, or?
Yeah, it's not as much calcium as limestone, but pretty close to it.
Okay. All right.
I mean, it's
Thank you.
good for our soil here. Compared to you go down to green down here and you got a whole different thing. You got granite type rock, which is not near as good as the Culpeper rock. So anyway, so we're going to talk about a little bit about stagflation and what you might do about that. And I've got a couple of short videos here that this one that I'm going to play is this one was a year ago, and it's kind of interesting that it didn't happen over the last year, but and we'll play one from a day ago.
Inflation meaningfully above the Fed's target could potentially put the U.S. into stagflation. Joining us right now is Oksana Aronov, who is the head of market strategy and alternative fixed income at JP Morgan Asset Management. And Oksana, that is not something anybody wants to hear, this idea of stagflation. We have so many people who are thinking, okay, it's going to be one more Fed rate hike and then they're done. And by the end of this year, we're going to see Fed cuts. You don't think that's the case? I think the kind of investor tries to rhyme their worldview with whatever data they can find. And there's plenty of data to support either view. And I think that's really just
no video.
More nuanced discussion than the reductive narrative that's done today, which is that We're heading for a slowdown.
No, it's been it's like grayed out.
About now.
Our next guest says an economic slowdown and inflation meaningfully above the Fed's target could potentially put the U.S. into stagflation.
Video now.
Joining us right now is Oksana Aronov, who is
That's good.
the head of market strategy and alternative fixed income at J.P. Morgan Asset Management. And Oksana, that is not something anybody wants to hear, this idea of stagflation. We have so many people who are thinking, okay, it's going to be one more Fed rate hike and then they're done. And by the end of this year, we're going to see Fed cuts. You don't think that's the case?
Every kind of investor tries to rhyme their worldview with whatever data they can find, and there's plenty of data to support either view. And I think that's really just the point, is that it's a much more nuanced discussion than the reductive narrative that's dominating today, which is that we're heading for a slowdown, and depending on who you're listening to, a severe one or a milder one, but the Fed is going to cut hundreds of basis points, and therefore you should own interest rate risk here, or duration, lots of duration here. And that, of course, conveniently ignores the fact that inflation is still uncomfortably high, not just here in the U.S., but also across the pond. Europe is still running very, very high inflation levels. Their core actually moved up in March, and the U.K. is at 10.3%, which is a record, frankly, for them. So inflation remains very much an issue, and we know that as goes inflation, so goes the correlation between stocks and bonds, meaning when inflation is high, that correlation is positive because the Fed's hands are tied to deliver the kinds of cuts that make bonds really that sort of port in the storm for portfolios. So I think, yes, we could potentially be headed for a stagflationary scenario, and that's not really a narrative that's out there, and I think investors have to contend with it.
Is that your most likely base cases, or is that just something that there's a risk of?
That is something that there is a risk of. And if we are in the business of building portfolios that can withstand a variety of scenarios, it's certainly one that we have to think about, as opposed to just kind of resort to old ways, which is that, we're going back to zero. And that seems to be kind of the preferred outcome and the hope that is dominating strategies out there. And today, it's really hard to point, frankly, to any data point and say, this is recession right here, right? There are some trends, but even when we look at the jobs number that, came out weaker yesterday and has been on a weaker trend for 8 months, but the unemployment rate has actually fallen over that period of time. So levels really matter. And it's going to be a lot more difficult to go from 5% to 2% on inflation than it has been to go from 8 to 5. And as long as inflation remains meaningfully above the Fed's target, the Fed funds rate is going to remain meaningfully above zero. And that means, higher for longer. And what does that world really feel like? We haven't really lived in that world for so long. Government balance sheets, corporate balance sheets, everything will have to adjust to the reality of higher for longer.
So how are you telling people to adjust their portfolios? What do you do?
Today, it's really, I know that holding liquidity is kind of this four-letter word almost in investing, but there's really no shame in holding liquidity because you are earning 5% at the very short end of the curve. And then attacking opportunities as they arise. We just had an opportunity in the banking sector, right, on the back of all of the stress, and there was an opportunity to pick up the AT1s if you weren't already in them, if you were an opportunistic investor. And the same thing with investment-grade floating paper, for example, that also winded out on the banking stress. So and this was really just one of the many unpleasant surprises that we are going to go through as the effects of this hiking policy will continue to take root. Because remember, yes, we're closer to the end of the hiking cycle than we are to the beginning. I think we can all agree on that. But we're just at the very start of what that means, what the effects that will have on the economy and on markets. And investors should preserve optionality here and beware of consensus, which is pushing them into the market, and it's too early for fixed income.
So you're saying T-bills?
T-bills, so the very front end of the curve, essentially cash yields are 5% and moving higher, right? We expect another hike from the Fed. Why would we extend here and hope for hundreds of basis points of fall in the Fed funds rate, right? That's the only reason to buy a 10-year or something farther out on the curve. And there will be great opportunities as credit does dislocate as this year goes on, because frankly, irrespective of whether the credit dislocating because of risk free rate is moving up because inflation is more resilient, or it's dislocating because there is a recession. But that dislocation is coming. Be prepared to take advantage of it.
Oksana, thank you.
Thank you.
Okay. So, comments on that. One thing I got out of that was this is someone from J.P. Morgan. Okay, for one thing, and not Jamie Dimon, but someone from J.P. Morgan, a strategist, and she brought up not only is our country in this situation, but also many countries around the world. So how do you think that affects us?
A falling tide sinks all ships.
Yeah. And also the thing I get out of it is that, you know, if if all the countries are in the same boat, who's going to be the leader to get us out of whatever we're going into? The only potentials that are big enough, I would say, would be China and the U.S., but I don't think either one of them have the wherewithal to do that right now.
I mean, I think it may actually, in the short run, be sort of the opposite of a falling tide sinks all ships, because if the dollar is the cleanest dirty shirt, then I mean that's sort of the dollar milkshake theory. Maybe I don't know, Brother Apple, if you've heard about that, but the idea that that essentially collapsing capital markets in like Japan and Europe might draw more kind of strength, more capital into the dollar economy, which kind of saves our bacon for a little bit. Which, you know, the alternative to that is that the capital goes someplace else. Probably can't go to China because China's already sort of malinvested to the moon and back. But possibly to Bitcoin. You might have like a crazy Bitcoin spike if people decide that that's the future. But yeah, so I mean, it in terms of like practical, like what should you and I do about things? Probably means watch the dollar carefully, because I mean, like you sort of don't know whether people are going to be. Well, I would say watch Europe and Japan. Watch the sort of vulnerable periphery of the empire, for what goes on there as an indicator. Where that money goes as an indicator of what we ought to be doing here.
Yeah, Japan, kind of almost sunk the bond market all by themselves, about a month ago. And Germany is probably the worst basket case in Europe. Well, maybe not the worst, but they're in serious problem. So they're definitely not going to be able to help us. And who's going to buy all these treasury bonds that we're going to have to issue?
Well, and that's the thing that I mean, I lived through the stagflation of the 70s, and the dollar. I don't know who just said that, but the reason that the United States fared fairly well compared to other countries was because the dollar wasn't all that great, but it was the cleanest dirty shirt. Nobody had anywhere else to go. So at the end of the day, the only economy that was really that were growing in the 70s were the Arabs, and nobody really wanted to invest in Saudi Arabia.
Yeah, at the time. But now we got a competition possibly to the dollar with the BRICS. Whether that comes to fruition or not, I don't know, but kind of the only thing that goes back with a lot of history is still goes back to gold, I guess. We got a 5,000-year history there, but Bitcoin is acting just like it. But we've got what 17-year history or whatever it is. So
yeah,
it's an unknown.
Well, listening to those economists, reminded me of my college economics professor who said that the most distinguished thing about economists is that they are 100% successful at predicting the last recession.
Yeah, I've heard that one before.
They can tell you why things happened after the fact, but they really can't. They really can't predict what's going to happen. Just as that clip that you just showed was from a year ago, right?
Right.
So the negatives that they said potentially could happen didn't really materialize.
Not yet.
Yeah. Well,
one thing about the business cycle though is the longer you put off the inevitable, the worse it gets. When you got
well. Yep.
So anyway, that was one of Jamie Dimon's people that supposed to guide the corporation or the bank. And then here a day ago is Jamie Dimon himself for 2 minutes of wisdom. We'll see what he has to say.
We're coming in for a landing, okay? I don't know if it's going to be a hard landing, a soft landing, or no landing whatsoever. But the only caution I put in all of that is part of the reason that's all true, and we talk about American exceptionalism, is we borrowed and spent $10 trillion in the last couple of years. So during COVID, we gave a lot of money out. I think they did the right stuff to move early and quick, but I think it was clearly overdone, which led to the inflation and things like that. But it's still that way, and now the deficit's 7%, which is the largest peacetime deficit we ever had, is $2 trillion. What I just said is true around the world, my concern is inflation, in my view, may not go away so quickly, okay? And so you might go into next year, 2026, where it starts ticking up a little bit like it did in the 70s, because the Fed always says it's data dependent. Well, of course they have to be data dependent. Can you imagine them saying, we don't care what the data says? But the short-term data is deceptive. And so when you say dependent, I think we overreact to short-term data. But there's also future data. Doesn't exist yet, but you can predict it. Like huge fiscal spending, the remilitarization of the world, which is inflationary, demographics is inflationary, the green economy is inflationary, the restructuring of trade is inflationary. So I see a lot of inflationary things in front of us. They haven't all happened yet, but they're going to happen, and I think they will probably have an inflationary effect. So in the back of my mind, we're prepared for that. I don't think it's a big deal if it's 3.5%, the 10-year bond goes to 5 or 5.5. I think it becomes a big deal if it goes much more than that, and people are caught off guard and credit spreads start to gap out. And it's only a really big deal if we have stagflation, i.e. a recession with inflation. And I would not rule that out. I'm not talking about next year. I'm not making a forecast, but in terms of managing our exposures, all of us, I'd be thinking about that a little bit too. Inflation, in my view, may not go away so quickly, okay? And so you might.
Okay. And that's a 2-minute version. There's a 22-minute version out there if anybody's interested in watching it, but it kind of lays out his detailed prognostics, and like Sam said, I'm not sure he's any better than anybody else, but he is sitting on a $1 billion nest egg, so maybe he's been better than most. So anyway, so that was kind of a couple of people from different time periods saying what might kind of predicting what they think might happen, and like Sam, I kind of cut my teeth on, 79 and 80, and from there on with stagflation and high inflation and high interest rates and all that stuff. It kind of messes up all parts of your life, like if you want to buy a house, for example, or, mortgage rates in the early 80s were, like 15% or more. And that kind of prices you out of any housing. So something to be aware of.
And those interest rates, a lot of companies depend upon a line of credit to operate. So while we might be the cleanest dirty shirt in the end, which is lucky for us, it still could have a big impact on, the economy, about, what's available, how many jobs there are. So.
Yeah, and that people are working. I mean, the only group that they ever talk about that's capable of pulling us out of this thing is the American consumer. But what if a lot of the American consumers aren't working anymore?
Yeah. You'll have to rely on people with investments being willing to part with them.
Yeah.
At least jump starts things.
Yeah. We don't have who was it that bailed us out of the Great Depression? Was it the original J.P. Morgan, or I can't remember, but it was some big banker, millionaire back then instead of a billionaire, but back when $1 million was a lot of money.
Mm-hmm.
So, anyway, so now this one's a little longer, and it's from 3 years ago, and he's talking about again predicting stagflation, and he's talking about the best performing assets. And so let's go through this right quick. And
many renowned economists have become inflationists in recent times. What's more is that many are expecting anemic economic growth, and this makes perfect sense given the debt-laden state of Western economies. This so-called stagflationary environment is one we have seen before, and today we explore the best performing assets in that environment. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Now, the excellent team in Gold We Trust have released a fabulous treasure trove of economic data, which I've really enjoyed geeking out on. The link is in the description if you do want to take a look. 2 of their charts deal with asset performance in a stagflationary environment. And I think this information is absolutely key to being able to navigate the uncertain future we all face and understanding where real gains can be achieved. Now, they examine the stagflationary periods that were seen at 5 different points through from 1959 right through to 1982. And they then averaged the actual gains of the different asset classes for those different periods. So I thought this was absolutely fascinating and well worth understanding. Now, we can see the significant inflation in consumer prices in the US in this chart, and we know that central bankers and governments will certainly have a tolerance towards letting inflation run hot. The impact is, of course, more inequality, which is why this data that Ronnie, Mark and their team have put together is so important for all to understand. So if we take the best average nominal and the best average real or inflation adjusted performance from these periods, we can see that WTI oil was the best performer, averaging a 78.1% nominal and a 64.3% real gain. Of course, this was largely driven by problems in the Middle East, the Yom Kippur War, and what economist Anthony Sutton terms the created energy crisis. Nevertheless, we've certainly seen a dramatic rebound in the oil price recently, and expectations regarding underinvestment in the sector are encouraging many to expect three-figure oil prices in the not-too-distant future. Of course, oil remains a key cost-push inflationary driver as well. The second best performer was gold, generating an average nominal return of 38.7% and an average real return of 24.9%, while silver came in third with an average nominal gain of 26.9% and a real gain of 13.1%. The S&P 500 showed an average 20.8% nominally and just 7% in real terms. But of course there was wide sector variations within the equities market, which we'll look at in a moment. The dollar showed a positive nominal average gain, but was down minus 0.1% in real terms. And so while we've seen commodities really take off in recent times, as this great tweet from Reddit investors shows, prior gains in these stagflationary environments were up an average 12.3% nominally and minus 1.5% in real terms for the S&P GSCI index. And so looking at equity sector performance, the best returns in these periods were achieved in the materials sector, attaining nominal average growth of 31.4% and real growth of 17.6%. We've certainly already seen some significant gains in the copper, iron ore, lumber and steel sectors. Consumer discretionary stocks gained over 12% in real terms, although much may depend upon what takes place with real wage growth. For we know central bankers love inflation in everything but wages. Meanwhile, real gains were achieved in industrial stocks, energy, healthcare and financials, respectively. Furthermore, firms with high debt but significant pricing power would seem well placed for a stagflationary environment. Additionally, some of the top performers in the Weimar hyperinflation were farmers, and we're certainly seeing some of the elites follow in their footsteps. But we're also likely to see relative outperformance of certain emerging markets that don't face the same crushing debt burdens and have much more favourable demographics than ageing Western economies. Those that look best suited to benefits around the Indian Ocean and include India, Ethiopia, possibly Iran and even Indonesia. Access to the Indian market is easily available via ETFs such as the Wisdom Tree India Earnings Fund EPI. Yet direct exposure to Ethiopia isn't the easiest, with many of the African ETFs placing much larger weightings on the continent's larger economies such as Nigeria and South Africa. But of course any potential dollar spike is bad news for emerging markets. And then of course there's cryptocurrency, and love it or hate it, the market growth story is quite compelling. Market growth and the world's strictest monetary policy seems to actually create the ideal environment, the ideal recipe for growth. As the author of the Bitcoin Standard recently put it, Bitcoin's market value grew around 1 billion% in the last decade. If its next 10 years witness 0.0001% of the growth of the last 10 years, Bitcoin will be bigger than all the world's bond markets. And with forthcoming IPOs of stocks such as Coinbase, it now means you can actually avoid having to hold any crypto if you truly loathe it. Personally, I see the impact of cryptos as very empowering. Just consider how it has helped many in developing countries to avert domestic currency risk, provide a convenient source of saving, and facilitate people's ability to flee totalitarian regimes. Furthermore, it has educated a new generation on the dangers and problems posed by our central planners. Additionally, privacy is going to be a major theme in the years ahead, and while Bitcoin fails to offer real privacy, there are coins such as Monero and Pirate Chain which really do prioritize this, together with strict monetary policy. So there we have it. There's some historical data and some other picks that may help us to actually ensure that we can prosper in any stagflationary environment. Of course, all of these trades are potentially vulnerable to a wider deflationary environment, but I certainly do believe in the potential for emerging markets to greatly outgrow the Western economies of the world in years to come. So what do you think? Do let me know your thoughts in the comments below.
Okay, that should have raised some questions, or maybe eyebrows. Any comments or questions out of that?
I'd be curious to get people's take on his opinion about crypto and other those types of currencies and the impact that they've had in third world countries.
Mike, you got a comment on that?
Well, I just had to take the dogs outside, so no, unless somebody wants to repeat. Sorry.
You want to say that again?
Yeah, so I think they were talking about his description of cryptocurrency and the impact of that it's had in more third world countries where the local currency may not be all that stable. So folks are able to use that if they purchase crypto, which is a bit more stable. It's able to kind of safeguard them against any fluctuations that the local currency might have.
Well, it's been particularly useful in regimes that control their currency, and the population of those. I mean, Venezuela is one example. There are technical barriers, but apps do spring up, ecosystems do spring up to work around those. I certainly, like, for instance, operating in Venezuela, I have no idea. I have no idea what app the populace is using and trusting, but that'll be the hardest part if we get there. There's the usability aspect, and whoever solves that, there's going to be a level of trust, assuming, and I'm going with the assumption that the pessimistic assumption that an increase in usability that would get people on board right now may require intermediaries, such as like banks or things like that, which is sort of counter to the main fundamental goal of not having to trust others with your money, right? But fundamentally, all these have the option to bypass those as well, which our current system does not. So I missed the last part of the video, so I'm not sure. Was there context about that in the video?
There was a little bit that they were talking about crypto as well, but I thought it was, to your point, I thought it was very interesting. I don't recall him talking about the liquidity of crypto. Like, if it's a great way, certainly, yeah, to if you're in a place like Venezuela or Brazil where the currency is devalued so quickly, then crypto is certainly going to it's a cleaner t-shirt to work with, I guess. But to your point as well, the trouble that folks are running into now is is it time to cash out? If it's my given circumstance, like I've got all this money stored up in crypto, but now it's time to use it. Like, who's going to actually buy this from me, and how can I convert that back into a good or service or something that I can actually make use of? That, to your point, that there's not as many options right now. I'm hoping that there might change.
Yeah, I think it will. Most of those have sprung up out of necessity. right? And the people's alternatives are worse, and that's why they're there, and that's why we don't have them. Is our alternatives are usually for transactionally just better, and I say that as a crypto enthusiast. Um, but you're right. When the scales tip, I suspect you know it might not be as easy. I mean, even right now, you try to pay somebody in gold, and you may or may not get them to take it. Um, and So I think there'll be adjustments and things like that. But if it gets down to it, we'll figure it out just like the other companies or countries have. It just might be bumpy. I'm sure it was bumpy for them.
Yeah. I mean, gold, its biggest problem is divisibility. I mean, an ounce of gold is worth too much money, to go shopping with.
Yeah,
And it's where goldbacks kind of come in. They're kind of like the silver dime of gold. Get a transaction down to $5.48, or a silver dime, you get a transaction down to $3.50.
that's by vaporizing gold at a atom level on stuff, isn't it?
Well, I mean, I'm talking about using the real gold back. I mean,
Right. I just mean that speaks to its divisibility problem,
yeah, 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 yeah. So that can be a problem. But in the real world, like you say, people will figure that out pretty quick. You just get another tomato to the stack instead of change. And
Right.
so anyway, there's ways around most of this stuff. But I just wanted to bring up that hope is not a plan. And most younger people that have a 401k or an IRA or whatever, it's generally in the 70-30 portfolio, which 70% stock, 30% bonds. And then as you get a little older, middle age, they want to shift you into 60-40. And then as you retire, they want you in a 40-60, and heavier on bonds and supposedly less risk. But unfortunately, that's not been the case in the last 20 or 30 years. Um, bonds are not a buy and hold anymore for the widows and orphans that they always talk about. They're about as risky as the stock market. Well, more risky than the stock market here lately. So it's like I said, there's not too many buy and holds. One path is low beta securities. If you know what beta is, that's the ratio of how volatile a stock is compared to an index like the S&P 500. So uh, a beta of 1 would be the same as S&P 500 index, and if a beta was 2, then it would be twice as volatile as that. So you'd want something with a beta of 0.5 or whatever, that not as volatile, or that's inversely correlated, like maybe it just depends. I mean, sometimes it's all one market. If the Dow starts crashing, bonds will go down, gold mining stocks will go down, everything will go down for a while. And then after it's all over and people picking up the pieces, then hopefully, some of these things we talk about will get you from point A to point B over time, and you'll be able to pick up your finances and still have something that's worth something. So, but if you're actually going to stay involved in the market, I think everybody ought to learn something about shorting. And there's many options today without actually being short a stock. You can there's lots of ETFs that do that for you, and so you don't have to be a sophisticated investor to and watch your position every moment of the day. So anyway, as opposed to throwing darts at the Wall Street Journal and buying the holes in a up market in a bear market. It's a little different story than that. Got to be very choosy. The other thing I wanted to bring up is the good old rule of 72. And what that means basically is if you can get a 10% return, your money doubles every 7.2 years. If you could get a 7.2% return, your money would double every 10 years. It works in the opposite or the reciprocal way there, I guess. But the most important thing is well, and 20% doubles every 3.6 years. So that'd be pretty cool if you could double your money every 3.6 years. But what happens if you lose 20% in the market? What kind of return do you have to earn to get back to zero?
A lot more.
Like double more. So if the stock market drops 50%, which it has in many recessions in the past, then you have to get a 100% return on your remaining money to get back to zero. So that's why it's important to have a plan. Especially if you're a little longer in the tooth, because you may not live long enough to ever see that money come back to zero. So that's kind of why I think this is important to, especially for us people that are over 50, say, to not lose your money in a bear market. And if you have one or more orphan 401ks, in my opinion, nobody cares as much about your future and your money as you do. All these supposed money managers, a lot of them are just looking out for their best interest, not necessarily yours. There are some good ones out there, but a lot that aren't. I just would recommend that you take interest in your future, not depend on somebody else to with some stock ETF or whatever to see you through your future. So, anybody have any other questions on that? Comments? I'm going to stop recording and we'll call it a night on that.